Hi everyone, today I'll be reviewing and recommending two safe, reliable, and high dividend paying REITs. I've taken a few years off recommending REITs. The high interest rate environment in Canada was pretty painful for REITs. I actually made a video outlining all the issues I was seeing a few years ago, but I am seeing a few upsides with the US REITs. The rules in the US are more lenient when it comes to REIT growth, and they haven't had the turbulent interest rate environment like we did in Canada. I'm choosing REITs and dividends for the next few videos, even though you could call them distributions, I'm calling them the same thing. Since the growth stocks and the stock market in general have had such a wild 6 months, I'm looking to provide the viewers with something with more stability. Please like the video and subscribe to the channel for more videos and advice for Canadian finance if you're interested. Up first is Omega Health Investors, trading under OHI. They're trading at $37.74 USD per share. They pay quarterly dividends, but the annual yield is 7.1%, which is huge. So a $10,000 investment would get you $710 per year. Omega specializes in skilled nursing and assisted living facilities. These sectors should be ready for huge growth given the aging population. Their focus on long-term care properties provide a stable revenue stream, making them a compelling choice for income-focused investors, which is, I guess, the viewers that will be focused are clicking on this video. This is more of a defensive stock, meaning it moves slower than the overall market. If the market goes up by $1, this stock will only go up by 60 cents. However, it works in reverse as well. If the market goes down by $1, this will only go down by 60 cents. Take a look at the returns year to date. This is 2025 in April, in case you're watching this in the future. It's hovering around break even. However, the S&P has gone down 5.8%. So that's the defensive nature of it. Owning this stock will be less of a roller coaster, but don't take the term defensive to mean no returns. The stock has still been performing well. In the last 5 years, it's up 40%, and that's without taking into account the 7% yield. So you would have been up 40% plus another 7% of cash per year in your pocket. The second stock is a more popular one, and I have more to say. This is popular online. I'm recommending Realty Income. The ticker symbol is O, so it's just O on the New York Stock Exchange. Currently trading at $56.89 USD per share. They pay monthly dividends, and the annual yield is 5.66%. Their diversified portfolio includes over 6,500 properties across various sectors, including retail, industrial, and healthcare, like Omega Investors. This diversification helps reduce sector-specific risks, providing investors with more stable income streams. Realty Income is also a defensive stock. It doesn't move as high or as low as the overall market. The monthly dividend payments likely make it hard to grow at the same exponential pace as some tech stocks, but also real estate is a lot more stable in the US and it's a lot slower moving. So take a look at the year-to-date returns. They're actually up 8% this year, which is weird because the S&P 500 is down 5%, but also this 8% is a hard rebound from the drop they experienced last year. While they're up 8% and the market is down 5%, it's not as impressive over the last 5 years. They're only up 17%, but however, that's a 17% stock increase while at the same time having the monthly dividend payment of 5.66%. I actually can't do a better job of promoting the company than the graphic they have on their investor deck. Any public company, if you type in their name and then type in investor relations, everyone will have an investor section with these graphics and additional information for you, and Realty Income does a good job of it. They've had 129 dividend increases since they went public in 1994. So that's the last 21 years. They've been around for 56 years and they've been paying dividends since before they went public. And that's where you get this 656 monthly dividend payments. So they've never missed a payment. You can rely on the stability and the frequency of this monthly dividend payer. Lastly, since 1994, they've had a 13.4% growth, which is actually higher than the S&P 500 over the same time period. So let's just compare the two, if you'd like. Not that you should only choose one, but there's positives and negatives to each. The dividend yield, Omega Healthcare offers a higher yield at 7.1, but Realty Income still provides a respectable 5.66. The dividend frequency, Omega pays quarterly, whereas Realty pays monthly, which can be appealing to those who need more of a regular income, like a monthly paycheck. The portfolio focus, Omega, is concentrated only in healthcare, which is benefiting right now from demographic trends, but there's also a risk if the demo changes in the future. Realty Income has a diversified portfolio across multiple sectors, mitigating any risks of something going down. Like if retail went down during the pandemic, they still have residential. If healthcare goes down, they still have the retail or industrial. You can see they both have their merits. I wouldn't pick just one. They each have their spot in a dividend investment portfolio. That's it for this video. Let me know if you have any questions. Thanks for watching and tune into the next one.